Hello, everyone. This is AJ Weisler, a member of Husch Blackwell's Labor and Employment Law Group, and we are excited to be talking with you today about dialing in on dialing up salaries, practical steps for adapting to the new Department of Labor overtime rule. Before we begin, I would like to cover a few housekeeping items. At the bottom of your audience console are multiple application icons for your use during the program today. I would like to take a minute to highlight a few of the key icons for you. If you have any questions during the webcast, please submit your question via the question box. We will try to answer all questions during the webcast today, but if a fuller answer is needed or if we run out of time, we will answer it later via email. We truly appreciate audience participation and encourage you to submit questions. There is also an icon to assist with your viewing preferences. Accordingly, please note that you can expand your slide area by clicking on the maximize icon on the top right of the slide area, or by dragging the bottom right corner of the slide area. If you have any technical difficulty, please click on the help icon. It has a question mark and provides information regarding common technical issues. A copy of today's slide deck and additional materials are available in the resource list icon that looks like a folder at the bottom of your screen. This program has been approved for continuing legal education credit in Colorado, Illinois, Iowa, Missouri, Nebraska, Tennessee, and Texas. Wisconsin credit is pending. To report your hours in Illinois, Nebraska, Tennessee, or Texas, click on the CLE widget at the bottom of your screen and complete the questions. Additionally, the program is approved for HRCI and SHRM credit. A recording of the webcast will be available tomorrow for watching and sharing. Once available, a link to the recording will be emailed to you along with a certificate of attendance. Joining me today is Scott Myers, another member of our Labor and Employment Group. We're going to be talking today about the recently announced final rule of the overtime, change in the overtime policy that will take effect at the beginning of next year. And to do so, we're going to go through a number of different parts, beginning with the discussion of the actual rule changes. And there are not a lot of them, and for the most part, they're fairly straightforward. And so that's why we're going to spend a lot of our time today not just talking about or describing those rule changes, but really focusing on that second bullet, which is strategies for how to comply. Meaning beyond just taking everyone who doesn't get paid enough money to be exempt and paying them more, or taking everybody who doesn't get paid enough to be exempt and turning them into a non-exempt employee. We're going to talk about other ways, sort of within those possible strategies that may assist your organization in meeting the new challenges of this rule. We're also going to talk a bit about how to take advantage of the rule change. You know, there is a silver lining here that goes beyond just some of your employees making more money. Instead, there are opportunities for organizations to make changes and use this time period to further enhance your compliance with federal and state wage and hour law. And finally, in the last bullet, in the last portion of it, Scott and I are going to talk about possible additional changes to the overtime landscape, which is otherwise known as the period of time in which we guess and speculate wildly and somewhat irresponsibly about what might happen in the future. And without further ado, I'm going to pass it over to Scott Myers to start talking about the changes.
Thanks, AJ. Like you mentioned, my name is Scott Myers. I'm an attorney in our Labor and Employment Group in the St. Louis office. And part one, we just want to give you some background about the changes, you know, kind of the nuts and bolts of what is actually happening here. And inside of this section, we're going to give a little bit of a timeline of how this process works to kind of conceptualize everything that you're going to be hearing, and then give some specifics about what is actually changing. Okay, so here is kind of that, you know, timeline step by step of how the administrative rulemaking process works, and we included some dates so you get an idea of really for how, you know, kind of quickly this happened. Really, it was in just March of this year when the DOL provided notice of the proposed rule, and then they, per the standard policy, people were able to submit comments to the DOL for about 2 months. The DOL reviewed those comments. We don't know how seriously they took them, but they tell us that they reviewed them. And then a final rule was issued just recently on September 24th, 2019. You'll see that the effective date is not until January 1, 2020. So right now we are in that period between step 4 and step 5. This is the time where employers like you can evaluate your compensation structures, figure out which employees are going to be affected, and how you want to go about addressing these changes. And that's what we hope to help you out with today, is identifying who you need to be looking at and how you can make any necessary changes. Okay, so what are those changes that are happening? Well, the biggest change, the one that's getting the most publicity, is the increase in the minimum weekly salary requirement. This is commonly known as the salary basis prong to the overall exemption test. Put simply, an employee needs to earn a certain amount of money on a salary basis to be considered exempt. That minimum amount is increasing for the first time in a long time. Now, there is a lesser known but related highly compensated employee exemption as well. We will get into more detail about this, but the new rule has also increased the minimum compensation for that exemption. This change isn't getting as much attention as the salary increase, but it is very important. We'll certainly get into more detail about the availability of using non-discretionary bonuses commission toward the salary requirement. It's a very useful tool, but it has specific requirements that must be followed in order for you to use it. Note that on all of these changes, none of them are making any changes to the duties test. And again, we will get into more about how you can make someone exempt, but there are really two parts, both salary and duties, and there are no changes to the duties test. Finally, while these are the first substantial changes in a long time, you're probably remembering hearing some similar information only a few years ago. You're not misremembering anything. We did go through a similar exercise in 2015, and AJ is going to tell you more about that.
That's right. So we will collectively jump into a time machine and we'll take you back 3 short years. And so those of you who were in your role that you're in now or otherwise engaged in employment law or HR likely remember that there was a rule that was announced, there was notice, there was comment, and it actually went to a final rule that was supposed to take effect in December of 2016. And that rule fairly dramatically changed the salary threshold, more than doubling it. However, in the week or so before that rule was to take effect, on November 22nd, a federal court in Texas struck it down. It was a fair surprise to a number of people, just given the timing and the dramatic manner in which it happened. We had spent the better part of a year working with clients to address how they were going to comply with the rule. And a lot of that work either was undone or was left in place, despite the fact that the rule had changed or had been struck down. And the reason that the rule got struck down, and we'll talk about this a little bit, is the court decided that, that because of the dramatic increase of more than doubling it, it went away from what Congress intended with these exemptions, which are to identify white-collar employees who work in executive, administrative, or professional positions. And the court determined that the Department of Labor had essentially set a salary-only test that didn't focus on what the employees did or what their role was within an organization, but rather focused solely on how much they paid. Or were paid. So that ruling was appealed immediately to the Fifth Circuit Court of Appeals, which covers Texas. However, with the Trump administration taking over in January of 2017, the rule was essentially abandoned. The appeal stays out there. It's held in abeyance. And now this 2019 final rule officially withdraws that. So to the extent that any of you have been going to sleep at night worried that at some point the 2016 rule was going to come back and get you, you can rest comfortably going forward, or at least until the rule gets changed again. So now we're on our first poll question. And that is to ask you to sort of reflect on what your organization did back in 2016, if you know. Did you make changes and then keep them? Did you make changes and then roll them back after the rule was struck down? Did you not make changes because you had no employees who were affected? Or did you, as some of our clients did, roll the dice on the rules being invalidated and end up winning when they were? So please do take a moment to answer this question. And then we'll see what your collective experience has been. So if we look at it, it's kind of across the board. Very few of you reversed the changes. A lot of you kept those in place. And obviously, those of you who are in that first category, you may have less work to do now as you're adjusting to the 2019 rule. Certainly, those of you who had no employees who were affected in 2016, you may also not have employees who were affected this time around. And we'll talk through exactly how to identify who those employees might be. And then finally, if you rolled the dice last time in the hopes that it would be invalidated, and it was, first of all, congratulations. You read the tea leaves better than I did. But secondly, I would not recommend that course of action here. We'll talk about possible legal challenges to this rule, but they are far more remote than the legal challenges that were brought against the 2016 rule.
Okay, so we're going to focus in on what AJ had just previewed as the white-collar exemption. There are a variety of ways individuals can be exempt from overtime under the FLSA and the similar state laws as well, but for right now we just want to focus on really what are the common ones that most people know about, and that are the 3 white-collar exemptions. This table right here, this is really a simplified explanation of them, and it also is showing how they stand today. Again, that new rule doesn't take effect until January 1. So as of today, you still have a salary level of $455 a week for all 3 of the exemptions. Now, the duties test that you see listed below, that's kind of the second prong of each of these exemptions. We're not going to really get into much of the duties test today. We'll touch on it later on as to why this is maybe a good time to review whether you have people properly classified under the duties test, but we're just going to be focusing on the salary prong. Okay, so what are the actual changes to the standard salary rule? Well, it has increased from $455 a week to $684 per week. So it's not a substantial increase. As you can see on an annual basis, it's from $23,660 up to $35,568, but it's enough to where there are going to be quite a few employees affected, as you will see later on. You might recall from the 2016 rule that there was an automatic update provision in that rule. That did not make it into the 2019 rule. So for the time being, this will be the new salary level until further notice. Earlier, I had mentioned the ability to use non-discretionary bonuses or commissions, incentive pay in the calculation of an employee salary. That rule allows for up to 10% of the salary basis to be met with those other types of compensation. Again, this is a useful tool, but it is tricky, and we're going to cover some examples. Now, this is just that table again, kind of showing you what is different between what we saw before. You can see it's just a small test. There's some nifty animation really calling it out if you weren't able to notice it before, that just the salary is changing, but none of the duties are changing. And now, AJ is going to give you a little bit more information about who's actually being affected.
Yeah, so how do you identify in your workforce who to focus on? Because there was only a change in the salary requirement, that's really all you need to do. Take a look at who do you have that earns between $455 and $684 per week, and individuals who you already treat as exempt, or at least meet the duties test for the executive, administrative, and professional exemptions, and individuals who work more than 40 hours per week. Obviously, if they don't work more than 40 hours per week, or they never work more than 40 hours per week, the overtime obligations under the Fair Labor Standards Act won't be implicated. The DOL did a survey and estimated that that's approximately 1.3 million workers across the country. Another fun statistic here, you might be wondering how 684 was determined as the number. It's a pretty random one, or 455 for that matter. The Department of Labor used the wage survey that the Department of Labor conducts and the Bureau of Labor Statistics, and they used the 20th percentile, so the bottom 20% of salaries in the lowest earning census region, which is the South. And that came out to, using sort of the most recently available data, that came out to be $684 per week. And that's the same method that they used in 2004 when they established the salary requirement then. So over the last 15 years, salaries in the South have increased by approximately $230, and that's the same increase that you're going to see now in the obligation. Another interesting statistic to throw out some numbers, and don't worry, because this is the Fair Labor Standards Act, we do have a fair amount of numbers, and we even get to do a little math later on. But at the same time, a lot of these we are going to focus on the practical. But one last number that's kind of an interesting one, the Department of Labor estimates that there are an additional 2.2 million workers who currently earn between $455 and $684 per week, who are treated as exempt, but do not satisfy the duty test for the executive, administrative, or professional exemptions. And so that's essentially the Department of Labor acknowledging that there are millions of workers who, in their estimation, are currently misclassified regardless of how much they get paid. And that's a reminder as we go through this that is something, even though only the salary test is changing, any organization should always keep their eye on the duties that their exempt employees are performing. So now we're going to talk a little bit about the highly compensated rule. So the highly compensated rule is a rule that creates a lessened, less rigorous duties test for certain employees who meet a certain compensation threshold. So you take what we identified as the exemption for the executive, administrative, and professional, and you replace the job duty tests with a simplified requirement that if they earn more than $100,000 in total compensation, that's anything, bonuses, commission, salary, any amount that gets them over $100,000 for the year, all we have to do then is determine that their primary duty is non-manual work and that they customarily engage in one of the exempt duties for the others. So it's a much less rigorous test that definitely reduces and makes it simpler to feel comfortable having exempt or determined to make exempt these employees. So there is a change to that rule, and that change is tied to that threshold. So it requires individuals who are exempt under the highly compensated employee exemption have to be paid a salary that meets the minimum threshold. So before they had to be paid $455 per week. Now they have to be paid $684, and then it also increased the annual compensation from $100,000 to $107,000, and that was using the 90th percentile for salaried employees across the country. It's how they settled on $107,000 per year. So the change to that test, again, it changes the total weekly salary that they have to receive, because to be exempt, they still have to get that, meaning as long as they receive $684 per week, all of the rest of the money to get them to $107,000 can come from other compensation. It could come from, again, commissions, bonuses, other variable type of incentive payments.
Okay, so now that you know how the highly compensated rule is changing, let's look at who this will actually impact. And kind of obvious, but employees who earn between $100,000 and $107,432 fall into that affected zone. So someone you might have exempt under this rule with a $100,000 in annual earnings is at risk for losing their status unless you make some changes. The DOL estimates that just over 100,000 workers will be impacted. That's obviously a lot less than the white-collar exemptions, but it's still equally important if you have someone in your organization who fits into this category. So just because it's not as widely known, you still have someone who may be able to claim for overtime all of a sudden now that traditionally has not been able to. Okay, this brings us to our second poll question, and this one we are asking, what concerns you most about the change in the salary threshold? Obviously, there are a lot of pressing concerns here from a cost standpoint, just an administrative standpoint. The record keeping is going to be a major issue, and then obviously morale as well, whenever you're changing compensation from a salary to hourly or vice versa. So we'll give you a moment to select what concerns you the most, and then we'll see some results. Okay, so as you can see, a lot of you, which we're not surprised to see, are concerned about the morale impact. A lot of what we're going to be talking about today is ways to message different compensation structures to people to kind of soften the blow on things that are changing. So while there might not be a lot of, or really any difference between typical hourly pay and some of the alternative methods we're going to suggest, there could be morale benefits. Clearly controlling costs, came in second place, but I would say there's a pretty sizable gap showing that morale is definitely the chief concern here.
And it is true that when you are making this change, messaging is very important. And certainly, and we'll mention this probably at least a few times, but the biggest thing you as an organization can do is essentially establish that these are changes that you're making to comply with the law, not changes that you're making to reflect, what you believe is the value of an employee to your organization. And as far as the controlling the cost for the increased salary expenses, the Department of Labor also did a survey to identify, and a study to identify how much they think this change is going to cost employers. And their estimate is that it will cost employers in the first year, so that year being 2020, across the country a total of approximately $543 million. And that includes administrative costs. That includes the time that you all are spending on this webinar learning how to comply with it. It includes legal costs. But it also includes that additional labor cost that you're going to have. And the Department of Labor separately calculated that figure, which in its literature describes as a transition of money from employer to employee, which I think is an interesting and fun word. But they imagine that they're going to transition $396 million in the first year from employers to employees. And so certainly the purpose of this rule is to increase compensation for a segment of the work population. We are going to talk about strategies to minimize that on your workforce and to, at the minimum, gain some control over what those are going to look like. So we're going to talk about that plan. So the first thing you have to do is identify who all is affected. Going through your workers to identify those people who fit in the bands where their salary will no longer be sufficient. And from there, you have to identify how you're going to comply. It could result in increasing their salary compensation. It could also involve converting them to a non-exempt status, which could be as simple as an hourly rate, but it could also be, and there are some alternative non-exempt pay structures that we're going to talk about. We'll go into a fair amount of detail of each of those. But first, Scott's going to talk about increasing that salary threshold.
Okay, so this is really the simplest and most obvious solution. You would just be raising the salary to meet the new threshold. There's really not much more to it than that. You need to remember that does focus on a weekly rate, which we've included there. And I want to draw your attention to that last bullet point. We have seen some case law where courts are skeptical of individuals who are at the very bottom of the threshold, especially when they earn less than non-exempt people. So an example that is common would be maybe you've got a production facility, you have a highly trained maintenance mechanic who makes more money than the supervisor who manages him. Now that is going to be a situation where the mechanic is non-exempt because with his duties, he's not going to be passing the duties test. He's not considered a white-collar employee. But you may have that supervisor who is going to be exempt, even though he's making less than the person he is managing. That's kind of something that courts are weary about, and they may look to see if you're just trying to get around the exemptions here or one way or another. So if you're going to run into a situation like that, that's something that you want to be aware of and figure out how you want to address that.
One nice thing that the DOL has given employment lawyers like Scott and I is some language that we can use because they did say that once you're over that salary threshold, the focus on exemption should turn solely to the duties. So hopefully we'll be able to convince courts going forward that they shouldn't be so concerned about how much an employee is making as long as they are making the minimum salary that's required and then also engaging in the job duties that make them exempt.
Okay, so now let's get into some more detail about using that bonus commission compensation to make up a salary difference, because again, this can be something that is really useful as long as you're following all these requirements. As I stated before, you can do this for up to 10% of the weekly salary requirement. That comes out to $68.40. Now, I usually don't like to brag, but I will say that I did that math without using a calculator. I may not be as good as math as AJ, but I was able to come up with that one. And then in addition to the 10% requirement, there are some other restrictions. The bonus must be paid annually or more frequently. Now, if someone is receiving bonuses or commissions, you're likely already paying them on an annual or more frequent basis, but just keep in mind that you do have to make sure that that is part of the compensation structure. Also note that you can set the applicable year. Year doesn't have to mean calendar year. That is the default rule if you don't have it defined already, but you can use a fiscal year. Let's say your company runs on a July 1 through June 30 fiscal year. You can use that. It doesn't have to just be a calendar year. We just want to make sure that you have this clearly defined when you are coming up with this compensation structure.
And they did build into, the Department of Labor built into this bonus or commission portion of the salary test a catch-up payment, which essentially allows for your employees who fail to earn their variable incentive or commission amounts for whatever reason, an ability to remain exempt, which is based on you, the employer, making a one-time payment at the end of whatever your year that you use to calculate this exemption in the first pay period. So essentially, you could have an annual bonus that's earned at the end of the year, and if the employee fails to earn it, but you've taken a credit against their salary requirement throughout the year, you would then owe them that 10% of the total standard salary level for all of those weeks at that time. Now, some complications come up with this. One important one being, what about employees who work a partial year for you? So what if you were taking this 10% credit against the salary requirement using the commission or bonus structure, and an employee leaves or is hired in the middle of a year? If they're hired, it's fairly simple, right? You take the number of weeks they actually work during the year, you prorate that amount to ensure that their weekly earnings meet the threshold. If they're terminated in the year, and maybe many of you have bonus policies or commission language that says if you leave or aren't still employed at the time that a bonus is earned, that you don't, or that it's paid rather, you don't earn it. If that's the case, you will have to make an exception to that policy, and you will have to make the makeup payment, the catch-up payment, to an employee who you are terminating at the time of their termination. And obviously, there can be some very challenging compliance obligations on you. If you have operations in states that have very specific requirements regarding payment of wages upon termination, meaning you may need to make that payment sooner than that first pay period following in a jurisdiction like California, where you want to keep that employee exempt, but you also have to pay final wages on their final day of employment. So something you want to keep in mind if you plan to take advantage of this. And so now we're going to work through, and anytime you see red language or red lettering, get excited because it means that there's a little bit of math coming to you. And the first one we're going to do is take a look at what that maximum bonus allowance would look like for an employee. So you would have a salaried exempt employee, you have them earning $615.60 per week, and a bonus equal to just over $3,500. And as a result, together that gets them to the $684 per week threshold. And an example of the catch-up. Let's say you've got an employee who you're paying $650 a week. They're eligible to earn bonuses, but gosh darn it, they're just not quite good enough. And so throughout the year of 2020, and this employer uses that calendar year to measure the exemption, during that year, they only managed to earn themselves $156 additional dollars, which brings their total income to $33,956 for the year, $653 per week. That's not enough. So we have to make up that difference in the very first pay period of 2021. Again, this is assuming we're in a state that doesn't require payment sooner than that somehow. And we will make that payment of $1,612. Now, you may be at this moment thinking, if I have to pay the amount to get to the salary threshold anyway, why in the world would I take advantage of this particular mechanism for complying with the exemption? And there's a few reasons you might. One, you may already have in place bonus structures for your employees that they are already entitled to earn variable commission or variable either commission or bonus compensation. So you can keep their exempt status. You can raise their salary a smaller amount to get it to that 90% level. And then you can use the bonus structure that's already in place to satisfy the rest. And then assuming that they don't reach it, you can then pay and make up the difference. And the other reason is the same reason that I pay all of my bills on the absolute last day that they're due, which means I can keep this money in my bank account throughout the calendar year, 10% of the salary requirement for each of my employees, and hold on to it until the end and defer some of that payment without running afoul of any of the exemption analysis. And so that is one practical benefit of taking advantage. Now, there are some challenges. For example, the next slide shows you what proration looks like. If you have an employee who only works half of the year, and again, this is an employee who doesn't do particularly well, so they're earning $650 a week, but they only managed to earn a bonus of $78. You would take that amount that they earned, divide it by the 26 weeks that they worked for you, and make a catch-up payment that gets those 26 weeks to the weekly requirement. And obviously, there are challenges administratively that come from taking advantage of this, both tracking employees who are coming in and out of your workforce that you were using this 90% rule for, and ensuring that you do keep them exempt by paying them the minimum amount. So it may not be something that every employer wants to take advantage of, but it is certainly something that is included in this rule and is intended to add some flexibility for employers as they comply with this increased salary.
Okay, so here we just wanted to bring to your attention some considerations that go along with actually converting someone from exempt to non-exempt. It's a big change, not only in how someone is being paid, but also just how you are going to be tracking their time. Because again, you have to record and manage time in a way that you do not have to do for an exempt employee. All non-exempt employees have to have their time tracked. So here are just kind of 3 examples of areas where we see there can be some confusion. For example, exception timekeeping, that typically comes up where someone who works a regular schedule and you only have them report to you time when they work an irregular schedule. A classic example is like a receptionist who normally works from 8 to 4. Maybe they have to stay later one day because there's a meeting at the office and they need someone at the front desk to let people out. That receptionist would then notify you that they worked irregular hours. Rounding, this is one of the things that we see employers struggle with the most, and it's a really challenging concept to kind of make sure that you are doing it correctly. If you do it correctly, it can be great, but it's something that you maybe have never had to consider if you've had an exempt workforce, and now that's changing to some non-exempt people. So it's something that you just need to look into. And finally, meal and rest periods. This is one that is probably overlooked a lot because especially when you're an exempt individual, you can kind of eat on your own time. Maybe you want to skip lunch for the day. And in some states, maybe that's okay. But there are a lot of states, and everyone seems to be moving this direction, that have very specific and strict laws when it comes to meal and rest periods, including up to a specific time frame that they have to basically take their meal or rest period during their shift. So again, depending on what state you work in, you could have, especially somewhere like California, you could have some very challenging meal and rest period requirements that you have been able to ignore up until now. Okay, some other considerations in this: controlling work away from the job site. This is one that we're seeing a lot more and more, especially as a lot of workers are becoming more mobile and they're able to work from home. Maybe someone likes to leave early, help get their kid to bed, and then log back on in the evening. That's fine if they're an exempt employee because you're not really having to track their pay or track their time. But now if they are being converted to non-exempt, you need to figure out either how to eliminate that or make sure all that time is captured. Because if someone decides to work at home and doesn't tell you about it, you can't just not pay them. You can maybe discipline them if they violated a policy, but you can't dock their pay. So you need to make sure that they are tracking that time to ensure that you are paying them completely. Travel time. This is probably one of the biggest areas we receive questions about, and we could do an entire webinar just based on travel time. We're not going to get into the details on that as much today, but just know that for exempt people, you could essentially ignore travel time. But now that you have to take into consideration someone's typical work schedule, the time of the day that they're traveling, the total distance traveled, and other factors as well. Again, we are not even scratching the surface on travel time, but it is going to be a major issue for employers who are now having non-exempt employees who may have to do some sort of travel. With changes in benefits and that kind of vacation and sick pay go along with that, we know a lot of employees receive certain benefits and PTO based on their classification. We are not benefits attorney experts or anything like that, but we do know that some employers are able to kind of modify their benefits plan to work around these changes, kind of just reclassify the types of employees who receive certain benefits. Again, if you have more questions about that, you can certainly reach out to us, but we won't want to get into too much detail on that now.
And Scott identified a lot of the practical administrative challenges that go along with that conversion of particularly a long-time exempt employee to a non-exempt position. And now I get to talk about the easy part, and that's figuring out how much to pay them. There is, and it's on the screen now, a fairly simple equation you can use to say, all right, if somebody makes a current weekly salary and I know how much they typically work in their hours, or I know how many hours we're going to essentially permit them to work or schedule them to work going forward, I can run some simple algebra to figure out what their hourly rate should be going forward. Doing that obviously is a way to essentially take somebody who's currently salaried and not impact how much money they cost you in labor costs. That's direct labor costs. There are obviously significant administrative issues that go along with it. And the biggest one is that you have to track their time, like Scott mentioned. There is no magic bullet that we can offer you that allows you to take an employee who is currently exempt, make them non-exempt, and then not continue to accurately track how much time that they work for you. That is something that has to happen. And we will stress that throughout, because I think that is From a morale standpoint, and I know you all were concerned about that, that is one of the biggest issues, is taking somebody who right now you say, here's an objective, go take as much time as you need to accomplish it, and you have to turn that person into someone who then tracks their time and reports it accurately to you. When you are making the conversion, if you're doing sort of a simple or sometimes less simple conversion to an hourly rate, you want to make sure that you don't just think of their base salary, but instead you consider all of the compensation that they receive. Because we have to include all of that when determining what their overtime rate is for the hours that they work beyond 40. We can go through some detail of that if anyone has questions, but for the most part, money that they receive in a bonus or a commission that's non-discretionary and tied in some way to or tied to the amount or quality of the work that they perform, we have to include in their regular rate, and that can increase then how much we owe them for overtime. Another important aspect of hourly compensation is that for almost all employees who work on an hourly basis, they're going to receive different amounts of money in their paycheck each week. It may not be huge differences. It may be, that some weeks they work as consistent a schedule where it doesn't change a lot, but we should see some variation because, again, we are tracking and paying them for the actual amount of time that they work, and it's very rare that an employee works the exact same number of hours every single week. And then finally, one note, and this is again one of those areas of this law that if we crack it open, we could spend an entire webinar on it, and that is there are circumstances where you can set an hourly rate that is different than a base hourly rate when an employee has two sort of distinct job duties or job activities that they do for you. And I'll mention, as Scott did earlier, travel is a challenging one, especially if you have currently exempt employees who travel for you a lot. And you send out and they do a lot of driving in between locations or traveling overnight, travel time can add up and it can become challenging to track. And one option you have is to set an hourly rate that essentially takes that travel time and gives it a value as long as that value is more than minimum wage, and it's totally distinct from the work that they're otherwise doing for you. That's one example of a situation where you can use two hourly rates for one employee. Again, these are narrow circumstances, so it's not like you can sort of parcel up every single thing that somebody does for you and assign it a different value, but there are some, and this is one circumstance where you can.
Okay, so here's that red font that we know all of you get so excited to see because that means we get to do some more math. This is just the most basic example of converting someone from hourly to salary. So here we have an employee who earned $550 per week, and they typically work about 50 hours per week. Now this person is no longer going to meet the salary basis test to remain exempt. If you want to keep paying them that same amount, you can use that formula that AJ described before, and you plugging in those numbers, you will end up with a $10 hourly rate. As you can see, the employee is still earning the same amount on average under this new structure. Really, all that we did was we reverse engineered what they were making before and are now paying it on a different basis. This is as basic as it comes, and some of the things we're going to talk about as we continue on are a little more nuanced, but this one is a very common one and should be pretty simple to implement. Okay, we have now reached our next poll question, and this one is straightforward. Does your organization currently employ any salaried non-exempt employees? Yes, no, or not sure. We'll give you just a moment to answer this one since it's pretty brief.
So we are identifying or asking if you have anybody who you currently treat as non-exempt, meaning they're overtime eligible, but you pay them a salary of some kind. And we're going to talk about alternative work structures where that's permissible, and we're also going to identify some where that is problematic. And the majority of you do have some salaried non-exempt populations. And so we're going to talk, because one of the challenges of this is the question, what is a salaried non-exempt? And what does a salary mean when you're talking about that with these individuals? And we're going to go through a lot of those options next.
Okay, there are four kind of what we're going to refer to as the alternative non-exempt pay structures that we are going to cover today. Again, a lot of these can be very detail-oriented, and so please don't hesitate to ask follow-up questions, but we will cover as much detail as we can today without keeping you guys here for too long. So the first one is a salary for agreed number of straight hours each week, and as you can see, that's different as compared to the next one, which would be a fixed salary including overtime for fixed hours. Then we're going to get into fixed salary for varying straight hours. That one is commonly known as the fluctuating work week. So maybe you used that term or heard that term before. We're going to discuss that. And finally, a really lesser known one called a BELO contract. It's a fixed salary, including overtime for varying hours up to a guaranteed 60 hours. That is a very narrow exception. There is a good chance that you don't have anyone in your organization that would qualify for a BELO contract. But for those of you that do, there can be some added benefits for using a BELO contract. Okay, that first structure we're going to talk about. Salary for agreed number of straight hours each week. Now this is a structure that I think is really better explained through an example, and we will certainly show you one, but there are just a few things that we want to point out. Primarily, this salary does not include the overtime premium. That is very important. You have to recognize that if someone is working overtime hours, then this amount that you are planning to pay them will increase. You must pay that entire salary in any week where work is done. So if you agreed, to pay a certain amount to 40 hours and they work 35 hours, you are still having to pay them that same amount. Okay. Note that this is different than expressing an hourly rate as a weekly rate based on an assumed number of hours. It kind of sounds similar, but there are some key differences. So using that comparison, if you agree to pay someone $10 per hour for all regular hours worked, that would be $100 per week if they worked 40 hours. Now, compare that to what we're talking about here. We will pay you a salary of $400 per week for all hours worked up to 40 hours worked. The operative language there is up to 40 hours worked. Like I was mentioning before, if you work 35, you still are having to pay them the $400. If they work 45, you're going to have to pay them more based on the regular rate that you guys had agreed to. So again, there are some small nuances there that you should recognize. And now AJ is going to talk about an example which should help put this into a little better context.
Yeah, and I think that the distinction is important because if we are offering somebody or want to communicate to somebody how much they're going to be paid, especially if they're in a position that either we previously had as exempt or we view as sort of exempt, or similar to an exempt position, we often hire that person and we want to describe them the salary. We want to say that they earn a salary. And sometimes we express it in an annual basis, and we need to be clear to them in all of our written communications and all of our discussion. Are we talking about a guaranteed salary that if they work an hour, they get it? Or are we talking about if they work sort of an assumed number of hours, this is how much they're going to earn? Because it does change our obligations. So this is what an example of a salary for an agreed number of straight hours would look like. We hire somebody, we tell them we're going to pay them $600 for all the hours up to 40, and as a result, that creates a regular rate of $15, which is that salary divided by the 40 hours that it covers. So if they work 30 hours or 1 hour, we pay them $600. If they work 40 hours, we pay them $600. But then when we go beyond 40 hours, we're going to owe them that overtime premium of 1.5 times their regular rate for each hour. So obviously going from 40 hours at $600 to $825 at 50 hours. So even though we have agreed to a salary, sort of a minimum compensation, that does not eliminate our obligation to pay overtime. And as Scott mentioned in the slide, you can have this be any amount of hours, which could be below or over 40. So for example, and actually just really quickly to compare this to just telling somebody they're being paid an hourly rate, right? If you have 40 hours, the same numbers between a $15 rate versus a compensation, the difference is that if we tell them it's a $15 rate, when they work 30 hours, we owe them less. But you can also do it where the agreement goes beyond 40 hours. So here's an example where we agree to pay someone $600 for 50 hours per week. And as a result, if they work 30 hours, we pay them $600, 40 hours gets $600, 50 hours gets $600 in the base salary, which covers all of those hours, and then a reduced amount of overtime because they're being paid only the 0.5 multiplier because we've already paid them for those straight hours by making the salary cover up to 50 hours. So again, when we have a communication with an employee and we tell them we're paying them a salary, we need to be very clear what that salary actually means. Comparing that to an hourly rate of $12 an hour, we are paying more for an employee who works less than 50 hours, but then after 50 hours, it ends up being the same amount of money.
Okay, now we're going to look at our second alternative pay structure, and this one is the fixed salary, including overtime, for fixed hours. This is good for employees who work regular hours with overtime. But if the employees deviate from their regular hours, you will have to adjust their compensation. We want to be clear here. This doesn't actually in any way alter what you have to pay. You're not really going to be saving any money if you do this type of structure. But this is one, again, where it can have a messaging benefit. We saw in that poll earlier, a lot of you have concerns about morale. This is one where it appears to be more like a salary. It is not just a straight hourly, even though when you really break it down, it essentially is being paid like that. Okay, let's look at that example. This type of structure makes the most sense where an employee works, 5 10-hour shifts. A 5 by 10 employee, this is one that can be really useful and certainly help with the messaging. So for this employee, you agree to pay $550 if they work 50 hours a week. Now, again, if they work less than 50 hours, you will pay them less than the $550. If they work more than 50 hours, you have to pay them more than the $550, as you can see on that example there. If they're working 50, it's all the same. 45 is less, 60 is more. So there's really not a cost-saving benefit in that situation. What you have to do here is you have to make clear that this salary number includes overtime. Otherwise, a court may consider all of this compensation as regular pay, which would result in a lot of owed overtime because their regular rate would be really inflated from what you had intended. Put that in writing, what you've agreed to. Ideally, have them sign it, because the benefit here is messaging of the salary, but not necessarily saving any money. And if you look, here is just an example of if you're paying that same employee an hourly rate of $10, you're not saving anything in this situation. It's going to end up being the same as to how much they're making under either structure. So it's purely just from a messaging morale standpoint, one for you to consider.
To the extent that you're thinking, man, a lot of these don't seem to be saving us a ton of money, or they just seem to be adding complexity to how we pay our employees, and if that has caused you to start to stare out the window and wonder when it's going to get warmer if you're in a cold place or colder if you're in a warm place, let me tell you that this one is the one that actually saves some dollars and cents, and this is the fluctuating work week. And the great benefit of the fluctuating work week is that it blunts and sort of reduces the impact of overtime hours, because it allows you to agree to a salary that covers all of the straight time hours, no matter how many straight time hours are paid or are worked in a week. So a few caveats to it. You can only do this if you have employees who truly work varying hours. So that could be somebody who is a supervisor, who you currently have as exempt, but because of their salary, they'll no longer be exempt. But based on the lines that they work on or the departments they cover, there are weeks they work a ton, and there are weeks they may not work that much. So you need somebody who does actually have varying hours. Courts will not permit you to use this for somebody who works the exact same number of hours every week, and you don't really get the benefit of it either. The important thing also is you have to remember you are agreeing to pay the whole salary even if they work 1 hour or 2 hours during the week. And you have to remember the salary does not include overtime. But the big thing that matters, the thing that helps us, is that the regular rate changes as they work, because you get to divide the salary you pay them by all of the hours that they worked in that week to get the regular rate, which means, and this is the huge drum roll benefit, as they work more overtime, the regular rate goes down and the cost of that overtime per hour goes down as well. So somebody who you have in your workforce who's going to vary and work a varying amount of overtime, you can reduce the impact on your books by using and taking advantage of the fluctuating work week. So this is what it looks like. If you have an employee who you have agreed to pay $600 for all straight hours worked in a week, no matter how many, the regular rate is going to vary. So if they work less than 40 or less, we're paying them $600. But if they work 50 hours, we're paying them $660. And we get that because the 50 hours, 600 divided by 50, and Scott mentioned I'm pretty good at math, and that equals 12. You take 12 times the 10 hours times the half, and you get an additional $60 in overtime. And if you take 60 hours, now you take that $600 salary divided by 60, and again, I'm pretty good at math, and I know that's 10. And so now their regular rate and the cost of that overtime has gone down, and you only owe them an additional 40 hours in overtime for those extra 10 hours. So this is a very significant tool to use to control the cost that you'll have. And if we compare that to a promise to just pay $600 for 40 hours, notice that the overtime for 50 and 60 hours takes them over $800 and then over $1,000. And if we use the fluctuating work week, we're at 660 and 700. So it is a very significant difference. The important thing, and we're going to say this several times, is that this only applies if there's a clear understanding between the employer and the employee regarding how they're going to be paid, which means that we have to be very careful to communicate and to put in writing that we are paying a salary that covers all of their hours. If we compare the fluctuating work week to an hourly rate, we also see, again, that we're paying more for an individual who works under. So under the fluctuating work week, we pay $600 whether they work 30 or 40 hours. Under the hourly rate, we would pay less for somebody who works less than 30 hours. So it costs us money there, but it saves us significantly on that overtime once they get over 50 and 60 hours.
Okay, I know that we're running short on time here, so I'm not going to spend too much on the BELO contract. Just know that this is incredibly narrow. It's a contract for an employee who works regular varying hours. Some weeks they work overtime, some weeks they don't. Now the variation has to be whether or not they work overtime, not just how much overtime they're working. And that variation has to be due to outside forces. So think of like a firefighter. An outside force might increase in hours one week as compared to another. The Supreme Court has blessed an agreement in which we pay a fixed salary up to 60 hours worked per week. Now, this has to reflect their actual work. If an employee never works up to 60 hours, you can't just agree to that 60-hour number. If they typically work between 30 and 50, you can pay that salary up to 50. So then if they work 55, even though that's less than that 60-hour maximum under the law, you have to pay more than what you have agreed to. So let's look at that example. We've got a fixed salary, including overtime for varying hours, up to a guaranteed 60. In this situation, the employee has agreed to $700 for up to 60 hours a week, and that comes out to a regular rate of $10. You'll see for 30-hour, 40-hour, 50-hour, and 60-hour weeks, they are being paid $700. But once they have a week that increases from 60 hours, you have to give them an increased amount based on how much overtime they're working. So that comes out to $850. Now let's compare this to just doing a regular hourly rate of $10 an hour for the same employee. On a 30-hour week through a 30-hour, 40-hour, 50-hour week, they are making less than that agreed upon $700 in the previous example. For the 60-hour week, it's the same, and then the 70-hour week, it's the same. Okay, so what really is that benefit to a BELO contract? Clearly, you can save money on the weeks where they work less than expected. Okay, well, the benefit there is that you can better predict and control your labor costs. For employees, a BELO contract offers a security of a steady weekly income. You know, it's a great way to try to attract certain employees that you would want to explain you are going to have basically a guaranteed amount unless you're receiving more than that. So again, it's very narrow. It doesn't apply to a lot of people, but it's in areas where you can use it, it certainly has some benefits that you may not have recognized at first.
So some general thoughts as you're considering these alternative structures. First, there's not a one-size-fits-all. You can't take your entire workforce, for example, and convert them all to BELO contracts. That would be wonderful for simplifying how you pay, but it's almost certainly not going to comply with the law, and it won't fit each position. There's also, as we mentioned, there's no magic bullet that prevents you from having to track hours for non-exempt employees. And you want to make sure as you're forecasting what a year looks like of this compensation, that you sort of model it out as you're trying to set hourly rates or salary amounts to determine how will this actually impact your workforce and how much money will it end up costing you and how much money will it end up costing them if the purpose is to sort of minimize the impact of a conversion from exempt to non-exempt. You also want to make sure you document that structure. So whatever the agreement ends up being should end up in writing, hopefully a writing signed by both parties, so that everybody understands when I say I'm paying you a salary of $600, this is what that means. These are the hours that it covers, to ensure that there is no confusion going further. And an important one is that you may have sort of had a spark of an idea as you were listening to us today about how can we minimize this impact, what can we do to reduce it, and I'm going to warn you not to get too creative. You know, we have identified and talked about essentially all of the alternative pay sort of salary lump sum type structures that the FLSA permits. If you get creative and your goal is to reduce the impact of overtime, you may end up with what are and have been identified as unlawful pay structures. The first is anything other than a BELO contract that pays the same amount of money for different overtime hours. And employers do this in different ways. One example is they'll change the regular rate depending on how much an employee works. So they'll say, I pay you $10 an hour unless you work over 50, in which case your regular rate drops to $8 an hour. And that way I end up paying you roughly the same amount no matter how many hours you work that week. You can't do that. you can't change an hourly rate for the purpose of avoiding the overtime obligations unless what you're doing is a true fluctuating work week. Also, you can't have a artificially low regular rate and then have varying bonuses that match it to a number. So we have had a number of employees our employers who we've talked to that had the structure in place, where essentially you pay somebody $8 an hour or minimum wage, and then you promise them, all right, well, you're going to make 10 grand or 5 grand a month, and so whatever you make on your regular rate, we're going to make up the difference in a bonus. And you can't do that because you've now, no matter what they work, overtime or not, you're paying them the same amount of money, and you are avoiding the fluctuating change that results from paying proper overtime.
Okay, we're getting to the silver lining. Again, this isn't all bad news. We want to talk about some of the positive aspects. But of course, we're going to start off with what isn't necessarily some positive aspects, because there is an increased focus on litigation in this area and how often we are seeing employers misclassifying employees. It is really true. This is a growing area, and it's harder to comply than it may appear. It's really one of those areas that is a case-by-case basis. Now, the best way to avoid a lawsuit is to identify and correct the exemption concerns and make sure that you are doing it correctly moving forward. But that's kind of a double-edged sword, because anytime you change someone's duties or compensation, that can raise red flags about whether you were complying in the past. So now we're going to kind of get into what that actual silver lining here is. This is an opportunity to maybe avoid those red flags that would typically come up by blaming the change in the law. This is a time where if you are making changes, you can communicate to employees that all of these changes are a result of the substantial change in the law, and you're not just randomly making a change because you realize you haven't been complying in years past. So what does that mean? This is really the best time to do a full audit, to not only look at how much you're paying someone, but the duties, and AJ is going to talk more about that.
So when we do an audit, we start with, and then this is sort of the basic outline of it, we essentially look at the job descriptions, we identify where we may have employees who are misclassified, and then we work through a solution, either by changing or consolidating job duties, by converting somebody from exempt to non-exempt based on what they do, by changing how they're paid. And this, obviously we have a short period of time between now and January 1, but depending on the complexity of your workforce, this is something that you can certainly do internally, at least for the purposes of identifying or flagging sort of the highest risk positions. And if you have or need additional resources or help with that, that is certainly something that we can help and provide. And it's certainly worth doing, because as Scott mentioned, there is nothing worse than telling a group of employees we're changing the way you're being paid and having it, no good explanation for it other than what appears to have been non-compliance in the past. Some additional thoughts. Now's an opportunity to update your job descriptions, especially if you have a job that's going to end up with employees who are both exempt and non-exempt, because some make more and some make less than the salary threshold. You want to clarify in your job description that's why the individuals who are not exempt in that position are not exempt, meaning this is not a decision that the duties don't satisfy it. It's just a decision based on the salary threshold. You also want to make sure that you keep everything documented, as you mentioned before, and as you take and make people non-exempt, it's an opportunity to strengthen the exemption for others by changing their job duties and taking those exempt managerial position duties and giving them to somebody else. Now we get to talk about the future. And the future is obviously difficult, and despite being good at math, we're not necessarily good at predicting exactly how all of this will fall out. But one important note is you may be concerned or may be wondering, should we be at this point making changes, or should we assume this is going to get struck down as well? And I will say that the Department of Labor, in putting together this rule, took a lot of pains to avoid the possibility that it would get struck down. Instead, what they focused on is matching it to the rule that previously existed and wasn't. One other important note is, as you probably have noticed, this is fairly a politically charged issue, meaning if there is a change in administration, there is likely to be a change in these exemptions or other overtime rules that follow from it. So certainly keep your eye on that. And we in the legal industry are always waiting for a possible change to the exemption duties test. And one that's been floated numerous times federally but already exists at several state levels is this expectation that employees engage in the activities for a certain number of hours. Thank you for joining us for our program today. We hope the information provided was helpful for you and your organization. If you have not already, please click on the survey icon at the bottom of your screen to complete our short survey. Your feedback assists us in providing quality future programs. As a reminder, this program has been approved for continuing legal education credit in Colorado, Illinois, Iowa, Missouri, Nebraska, Tennessee, and Texas. Wisconsin credit is pending. Additionally, the program is also approved for HRCI and SHRM credit. A recording of the webcast will be available tomorrow for watching and sharing. Once available, a link to the recording will be emailed to you along with a certificate of attendance. This concludes our webinar. Thank you.